In this video, we're going to look at 5 formulas that will help you achieve financial freedom, even if right now you find it like a very difficult goal to get. The sooner you start, the earlier you will reach it. Let's go for it. We start with one of my favorite formulas because it is able to measure a person's wealth. So listen carefully. Wealth is not measured by the money you have. Yes, you heard it right. Instead, the best way to measure wealth is by years of freedom. So if you want to know how rich you are, you have to apply this formula. Liquid assets divided by monthly expenses and all divided by the 12 months of the year. It is as simple as that. Let's use one of those examples that you like. Imagine a person who owns all the items that people associate with wealth. You know, a sports car, a mansion, a house on the beach, and so on. And, to give an example, imagine that all those possessions generate about $10,000 in fixed expenses per month. And the liquid assets of that person, you know, cash, deposits that can be cashed in days, etc. Anything that is extremely liquid, anything that is instantly available, is $200,000. Well, if we do the calculation, we divide 200,000 by 10,000, then we get 20 months of covered expenses. If we divide it by the 12 months of the year, we get 1.7 years. This person can survive with what he has 1 year and 8 months. And now imagine a person who lives in a normal way, in a regular neighborhood, with average expenses, and he has in liquid assets $50,000, which is not bad. And all his possessions generate monthly expenses of $2,000. 50,000 divided by 2,000 gives us 25, which is 25 months. If we divide it by 12 months, we get 2.1 years. Who of these two people is richer? Who has more freedom? Well, possibly the person who has average things, right? Since he would be able to cover expenses for longer while maintaining his current standard of living. The first lesson we draw from this formula is that you have to own things, but don't let the things own you. The next and most important lesson is that you should always have liquid assets to meet possible contingencies. In my view, the ideal number is 5 years. That is, your liquid assets should finance at least 5 years of expenses of your current life. This gives you the freedom and also a lot of peace of mind. If you are still far from this number, you should do it progressively. You can start by saving 1 year, then 2 or 3, until the end. Obviously, you don't have to have money standing still, but simply financial assets that are truly liquid, that is to say, that can be liquidated from one day to the next. For example, a property is not excessively liquid, since you need to sell it calmly and sell it at a good price. This could take you weeks, months, or even years. I'm talking about deposits, I'm talking about bonds, I'm talking about certain stocks that remain stable over time, etc. The following formula is great and very simple too, as it measures a person's financial freedom. As you have learned in other videos we have showed on the channel, to achieve financial freedom, you must have a collection of assets that generate passive income. Do we agree? Well, this formula tells you at what level you are. It's passive income divided by total income, multiplied by 100. This formula tells us what percentage of our income comes from our passive income and shows us how much we depend on our work. It's very simple. Let's look at it with an example. Imagine that we have a monthly passive income from our assets, such as stocks, bonds, and rented real estate, of $750. And on the other hand, we still have our job. We keep our job and we have a salary of $3,000. If we divide 750 by 3,000, we get 0.25. Multiplied by 100, we get 25%. This means that our passive income is 25% of our income compared to our payroll. As we increase our passive income, that is, as we increase our collection of assets, the percentage will go up until it eventually catches up or reaches the same amount. This means that if we earn $3,000 with our job and we manage to pocket $3,000 every month with our passive income, from that moment on, we can consider quitting our job if we are not happy in it and dedicate ourselves exclusively to what we desire. So we can say that this formula is the thermometer of your financial freedom and tells you where you are. Your mission with this formula is to overcome the passive income to your payroll, to the income from work. A very simple formula that undoubtedly marks your distance to financial freedom. The third very simple and revealing formula when choosing assets to invest is the ROI, which stands for return of investment. It is a very simple formula that tells you the percentage gain of an asset in relation to the money you have invested in it. To find the ROI, it is very simple. It is a matter of dividing the annual net profits that an investment gives us by the cost of acquiring that asset and multiplied by 100. Let's look at an example. Imagine that we have an apartment and we rent it to get an economic benefit. We can get about $800 a month, which would be $9,600 a year. We divide this amount by the cost of the apartment. Imagine that it has cost us $200,000. 9,600 by 200,000 equals 0.48 multiplied by 100 is 4.8%. ROI is a very simple formula that can help us when deciding whether an asset benefits or harms us. We can also take advantage of the ROI to make an average profitability. Let me explain. You calculate the ROI of all the assets you have, you add them up and divide it by the number of assets you have. In this case, in the example you see on the screen, the sum of all the assets is 17, and if we divide it by 3 it would give 5.7. This means that our average portfolio return is 5.7. If we know the average return we have in our portfolio, it allows us to select assets that exceed your current average return, so that the overall average goes up. Therefore, in the case of the example, you would be interested in selecting assets that exceed 5.7% annualized return. In this way, your returns will grow year after year. The fourth rule is very interesting, since it gives you a roadmap when buying a vehicle. It prevents you from buying a car more expensive than you should, and ruining all your efforts to achieve financial freedom. It is none other than the 20-4-10 rule. This rule applies when you want to buy a vehicle and you want to finance it. The 20 symbolizes the amount that you must give as the down payment when financing the vehicle. In other words, you must make one down payment of at least 20%. The 4 is the years of the loan. You should never finance more than 4 years to buy a vehicle. And 10 indicates that the vehicle expenses should never exceed 10% of your income. Gasoline, the monthly installment, etc. All the expenses from that vehicle. Let's give an example. Imagine that we have a salary of $3,000. The 10% of $3,000 is $300. That is the available amount that we have to pay the installment, the insurance costs, the repair expenses, and all the expenses that come from the vehicle. Based on this amount, we look for a vehicle that suits our needs and we find one that costs $10,000. The 20% of $10,000 to give in the down payment is $2,000. Therefore, we must finance $8,000, which in 48 months would come out to $167 a month. And I'm not counting interest to simplify the example. If we subtract 167 from 10% of our salary, which is $300, we would have left $133 a month to pay for gas, insurance, repairs, etc. As you can see, the 20-4-10 rule is a roadmap to make a safe car purchase and not ruin you in the attempt. We continue with another incredible rule that will help you a lot in your personal finances. It is the 10-30-60 rule, as it is an easy way to distribute your income and build your own budget. It is very easy. 10. At least 10% of your income should go to savings, especially for long-term goals. 30. No more than 30% for debt repayment or financed assets. It is important to remark that this 30 is not the minimum, but the maximum. And 60. 60% of your income for living expenses. As you can see, it is a much simpler savings system than the 6-account system, but it is a basic rule that, as a minimum, we must respect. There are other even simpler rules. For example, the Pareto Rule is 80-20. 20% would be savings for your financial goals and 80% for everything else. I personally like the 10-30-60 rule better because it is a little more comprehensive and puts the limit on debt. Anyway, there is also the system of the 6 accounts, which is more complete, and you can also see in the link I wrote in the description of the video. Let's continue. Well, at this point, let's do a review of the 5 formulas we saw in the video. To know how long you can be without working. It is liquid assets divided by monthly expenses, and divided by 12 to know the number of years. The next formula is to know what our passive income ratio is. What income our assets are generating is passive income versus the income earned from work, multiplied by 100. On the other hand, to find the ROI, is net profit between realized investment multiplied by 100. To buy a vehicle, make a safe purchase 20, 4, 10. Don't forget these numbers. A very good savings system is also the 10, 30, 60. Don't forget 30 means is the debt maximum to buy financed assets. And that's all for today. Thumbs up. If you want to keep learning about finance and financial education, subscribe to the channel and turn on notifications so you don't miss any video, and remember we can be in touch also on Instagram. Don't forget to leave your opinion in the comment box. And remember, smart work is the key to success.